Welcome to this comprehensive guide on arbitrage. In this video, we'll be covering everything you need to know about arbitrage, including what it is, how it works, and how you can potentially profit from it. To start off, let's define what arbitrage is. Arbitrage is the practice of taking advantage of price differences in different markets. In finance, it refers to the process of buying and selling assets in different markets to make a profit. Let's take an example to understand how it works. Imagine you're in a market where you can buy apples for $1 per apple. At the same time, in another market, you can sell those same apples for $2 per apple. If you buy the apples in the first market and sell them in the second market, you would make a profit of $1 per apple. This same concept applies in the stock market. Let's say that a stock is trading for $50 on the New York Stock Exchange, NYSE, but it's trading for $52 on the Tokyo Stock Exchange, TSE. If you buy the stock on the NYSE and sell it on the TSE, you could potentially make a profit of $2 per share. Of course, in reality, there are transaction costs involved in buying and selling assets, so the profit may not be exactly $2 per share. You'll need to take into account the cost of buying the shares on the NYSE and selling them on the TSE, as well as any other costs involved. Another important factor to consider is that the stock prices on different exchanges may not always match up perfectly. There may be a time lag between the prices on different exchanges, or there may be differences in how the prices are calculated. To take advantage of these price differences, you'll need to be able to monitor multiple markets and be quick to act when you see an opportunity. This is where technology comes in. There are now many trading platforms and algorithms that can help you to monitor prices in real time and execute trades quickly. It's also important to keep in mind that arbitrage opportunities are often short-lived, as other traders will quickly spot them and try to take advantage of them as well. This means that you'll need to be able to act quickly and decisively in order to make a profit. There are several types of arbitrage, such as spatial arbitrage, taking advantage of price differences between two or more locations. Temporal arbitrage, taking advantage of price differences over time. Statistical arbitrage, taking advantage of price differences between two or more securities. Let me give you an example of each type of arbitrage. Spatial arbitrage could be buying a product in one city where it's cheaper and selling it in another city where it's more expensive. Temporal arbitrage could be buying a stock before an earnings announcement and selling it afterwards. Statistical arbitrage could be buying one stock and selling another stock that has a highly correlated price movement. So, why is arbitrage important? Arbitrage helps to make markets more efficient by bringing prices in different markets closer together. It also provides liquidity to markets by creating demand for securities that may be undervalued in one market and overvalued in another. So, can you really make money from arbitrage? The answer is yes, but it's important to understand that arbitrage opportunities are rare and can be difficult to find. You'll need to have a deep understanding of the markets and the assets you're trading, as well as the ability to quickly spot and act on opportunities. With all that said, if you're able to successfully execute an arbitrage trade, the potential rewards can be significant. Some traders have been able to make millions of dollars through arbitrage trades. Thank you for watching this financial education video on arbitrage. If you have any questions or comments, please leave them below. And don't forget to subscribe for more financial education content.